Thanks everyone for joining us. We're going to go over the first quarter investment performance. We've got Andrew, Josh, and myself, Dave here. We're going to go through not only commercial, but residential and retail all in one setting. So if you have questions or things come up, please just put them in the Q&A section. It's on the lower part of the Zoom screen, and we'll answer those kind of as they come up. We have them in front here and we have them up on the screen here, so we'll be able to answer anything, as it goes through. We have a couple questions that people had sent in ahead of time, so we're going to cover those first, and then open up and see what else people think.
Sounds great.
So, all right, so we're going to kick things off with residential. So we're starting with our apartment and mobile home portfolio. With many of these assets we've owned for a surprising amount of time now. We were looking at Rosecroft that we've owned since 2016. Same thing with like Saddle Creek, who we've owned for 8 years almost now.
Yeah, two of the properties, Amberwood and Saddle Creek, we bought with these rental restrictions on them that, in our opinion, we would never see the end of them. And
it was a long way away.
They're like 10, 12 years away, and we're within 2 years on both those properties of them expiring.
I mean, if we look at Saddle Creek, so this is a deal, we purchased it in February of 2016, and it's 100 units in Alpharetta, which is north of Atlanta, and it's a very good area. So rents are
still below market. From
our rents are below market,
Yeah.
but the rents that are in the area are exceptionally high.
Yeah, our rents are tied to area median income and really a percentage of that, and it really has no relevance to what the market rents are and what the area can afford. So we were looking at the rents earlier today, what they were.
$4,000 a month, I think, is what you saw.
Yeah, like two to 4,000 is fairly average, and then there's even some stuff that's above that. I mean, obviously ours isn't going to get like $7,000 a month rent, which
my mortgage is not $4,000 a month. Just to
7,000 seems like a lot for rent. Maybe
Yeah.
you should
And we're
spend that on rent.
and we're restricted at what, 970-ish,
so-
maybe 1,000.
Yeah, if we're getting over 1,000 on stuff, it's like. But for the most part, the housing authority is paying the bulk of that rent and that cost. So for us, we've got a deal where it's well below what the market is. We're not re-renting that, but 2025 is when our limits on that expire. So at 2025, we can then start renewing. We can't just kick people out, and we don't plan to do that. But as people's leases expire, then we can start renewing them at higher rates, and that could be significantly higher than what they're currently at.
Right. And to capture those rates, when we bought the property,
It's
6, 7
February
years ago.
2016, yeah.
Yeah.
So you got to do the math on that one.
Well, we bought the property 7 years ago. It was freshly renovated for its use right now, which is really low income housing. So as we look to achieve higher rents, we'll look to basically accomplish the same thing we're doing at Amberwood and Kingstown right now, which is do a heavy unit renovation on the inside, new kitchens, new bathrooms, refresh the whole place upon turnover, and see how far we can push the market for the property.
Yeah, and we've done this on. I mean, that's really been our business model over the past 10 years, is doing these bigger renovations on assets. But if we look at Saddle Creek, and some of the questions that came in are, what do we plan to do, and how are we going to turn 100 units? So on average, if we're going to spend $20,000 to $30,000 a unit, you're talking about $2 to $3 million that we would need to start allocating in 2025 to turn these units. And we can't really say, hey, we're going to do a few units a month and we'll eventually get there like 7 years later. That's not going to work. So the only way we can really do it and have a reasonable financial return is to either get a construction loan to go borrow the funds to go do all of those units in a faster timeline, or add new equity to the deal. Right? That's really the only two options we see, because if we draw it out too long, we will essentially use all of our retained earnings for a 7 to 8 year period and make no distributions, which I think it's not the plan. I think you all have some more questions around that.
Yeah.
So we don't plan to do that.
Investors like distribution.
Yeah, distributions are good.
Yeah.
No distributions are bad.
Yeah.
So that's what our plan is on Saddle Creek, and we'll have more information as we obviously can't do a construction loan now. We're still 2 years out, but it is very much coming, and it's going to happen sooner than later. So we're working on that as we get to what that total cost is going to look like and what a construction loan could be as we get into 2025. So let's talk about two other deals that we're doing very similar thing on, which is Amberwood and Kingstown. So also two deals we've owned for a while now.
Right. And, you know, we've enjoyed, you know, we own them at such a low basis that we've been happy with the rental increases we're getting, you know, owning them at 30 to 40,000 a unit and getting rents in the 850 to 950 range it's been great. And there's really been no problem with it, but the neighborhood around us has gotten, in both Reynoldstown and further down Memorial Drive, has gotten substantially better. And the rents have leapfrogged over our rents. And now we're looking back and saying, man, we have so much more rents to capture.
Yeah, when we first bought Amberwood, I mean, they were burning trash in 55-gallon drums on the corners.
Nice.
And now there's $1 million homes right around there. So vastly different. Those unit turns there, we're still spending between $15,000 and $18,000 a unit. And these are typically smaller units than what we have at Saddle Creek. So Amberwood is a little bit smaller, but Kingstown are townhomes that are also, you know, typically 2-bedroom layouts. So with that, we are getting significant rental rate increases because we're doing these big improvements. But we're also not in a position where we're saying we're going to go kick everyone out and do all of these units at once. We're doing 2 or 3, you know, every quarter, every 2 quarters as those leases turn over. Sometimes we're able to just get pretty good, you know, organic rental rate increases on those, and then we're not turning that unit. That's the bulk of what we're doing on the renovation side right now. So I think this really started 2019 when we started saying like, hey, if we can find deals where we have a lot of equity and we have an opportunity to capture that equity, we would look at selling our apartment assets. And over the past 4 years, we've been mostly a net seller of assets, and we're going to continue to look at that as we are able to really capture large equity gains that we can then basically realize those gains and redeploy into something else.
Mm-hmm. And really, I mean, that becomes relevant with Rosecroft up in Charlotte, right? It's, we at the end of the year, normally January, February, there's a big conference usually out in Vegas or Orlando called NMHC. And coming out of that, we get heavily solicited to sell properties. And usually it's geared towards 1 or 2 of our properties, not all of them at once. And Rosecroft was just kind of the darling of the year, where we got solicited really just out of the blue by 10, 15, 20 offers in January and February. And so we just steadily worked the price up until it became kind of too good to be true. And we selected a buyer, and we're under contract right now. See what happens.
It's still early in the process.
Yeah, very
We're
early.
always, I would say if we're going to look at like a ratio of like interest to actually getting a contract signed to closing, it used to be good. I would say 3 years ago, 4 years ago. Now, you know, we've had multiple deals that fall out of contract regularly, which is more annoying than anything, because you kind of got this whole, you know, process you're working through, and then if that falls apart, that's more annoying.
Right.
But so this contract just started, and we would target closing right around like middle of July. So we still have quite a bit of time here before we, you know, get through everything. But it is something work said do. Overall, we were going through the math. We'd hit about a 35% IRR on a 6-year hold. So I think if we started this deal and said, hey, we're going to buy something and we're going to average 35% returns for 6 years.
Yeah, nothing. Usually you get a 35% IRR on a 2-year deal or a 1-year deal. 35%
It's easier if it's
IRR.
shorter.
Right.
The
But
faster you
35%.
sell it,
And you said this earlier, 35% on a 6-year deal could be one of your best ones over 6 years.
It's strong.
Yeah,
It's very strong.
good.
Yeah.
So, and that's, I mean, all the equity has been returned in that one already. So now it's everything that's coming out of it is profits. And we're making continual distributions there as well. So the deal is performing well. It's just, we have this great opportunity to capture a lot of value. So, okay. So a question kind of came in here is like, when will we be out under the rent restrictions at Amberwood? And at Amberwood, we are out on that one. So we are free to do whatever we want to do on rental rates at Amberwood. And we had purchased that one from essentially a nonprofit that had owned it for
A long time.
very long time. And yeah, and we're free there though now to do whatever we want on the rental rates.
Amberwood is our 8th purchase deal, and we bought in 2013. So it's
10
on
years
10-year
ago.
anniversary.
Yeah.
Wow.
All right, so let's dive into the retail stuff.
Oh,
Go through
okay.
kind of what we're
Just,
thinking on.
Thought I was last, but it's okay.
We moved you up.
I got moved up. Okay.
Promoted.
So we want to go back to the beginning of retail. We started in a fund format,
Yes, yes.
right? So we had our triple net fund one.
That was the first, and the first deal was, of course, now our favorite deal, F1N001, which is Zaxby's and Powder Springs.
We have since canceled the ridiculous naming convention and gone to our naming convention. So it makes sense. But yeah, so we bought a couple deals in this fund format, and everything post that has really been focused on buying brand value.
Right. Big brands, large companies with large balance sheets, brands that you'd recognize, brands that you've probably been to before. So that's been our focus for everything for retail, except for one property in the
One
fund.
special one, which
One
is
special
Edgewood.
one, which is actually a phenomenal property that's done really well because it was a hard one to turn down, but it's on Edgewood.
Yeah, very good location. I mean, Edgewood Avenue is, it's pretty close to the Amberwood deal we mentioned. One of our other deals we had was also on Edgewood Avenue. So
Right.
it's an area we like, and we have had good success operating there, even though we've had some challenges
Right.
here and there.
It's a high touch deal. It is a triple net lease, but it's a
Triple
mom and
net
pop
with love.
operator. Triple net what?
With love.
Triple net with love.
an
Yeah,
asterisk.
triple net.
Yes.
Yeah, with a little asterisk on it. But it's doing phenomenal. We unfortunately had a tenant that we had to evict, which was miserable because we had to evict him over COVID. But we went from I forget what the actual number is, but we went from effectively, I think, $12,000 a month rent to $16,000 a month rent. So we did a great job, created a lot of value with that new rent. And we have 3 assets left after we sold O'Charlie's last year. We have 3 assets left now in the triple net portfolio. There's Zaxby's, Edgewood, and a DQ. And we're looking into right now listing Edgewood for sale. And we're talking to, either the tenant will buy it or it'll go on the open market and we'll,
It
sell
would be
that
a
way.
great scenario if the tenant buys it. He opened the
Yeah.
business and has done very well there.
Yeah.
And
And he's doing great. He's doing as much revenue as like a major brand at Applebee's or something like that. So he's doing pretty well.
yeah, so that'd be exciting. Best case, that's a win-win situation if we can make our gains on the deal, but also sell it to an owner operator who's going to be there. It's good for his business that he owns the real estate too. So we're working to that with him. That'd be the next kind of transaction that we're looking at doing.
Right.
That's in the retail space. Other than that sale, everything else has been distributing.
We're distributing all of our cash. There's a couple of properties where we had some tax bills come in, and Dollar General, we have the luxury of giving Dollar General free loans. So we have to pay the taxes on all of our Dollar Generals, and they pay us in 60 days usually. So we give them a free loan for 60 days. And so sometimes those tax bills fall on a distribution quarter. And so then we have to kind of wait on distributions. And then when we get the tax money back, then we can catch up on distributions. Right. So for the most part, I think every single triple net deal paid. We, most of them, I think probably 70% or more of them paid full prefs. We're doing pretty good. We've been consistent on budget for all of them. And it's a consistent payer.
We did have some other questions too that came through on what new triple net deals we're going to be able to find, or what new retail deals are we going to be able to find. And we think about the opportunities that are out there. Yes, we're focused on major brands, but
well, yeah. So our whole triple net business or retail business, we stopped calling it a triple net business. So it's Greenleaf Retail. We're primarily focusing right now on deals where we can make money. So when you have debt at 6.5%,
that's our overall focus too. So we want to try and buy deals that are going to make money.
It's really good. So that's what we try to focus on. So, but when you're buying a deal at a 7.5 cap and your debt is at 6.5 cap, you don't have the spread to make money. And so typically we can't cash flow these deals anymore. So these reliable cash flow deals that everyone's used to, because of debt right now, going from 3.5% to 6.5%, they're very hard. And so right now we're focusing on short-term deals or fixing problems. So we're focusing on possibly like a 1 or 2 year triple net lease that we then turn into a 5 or 10 year triple net lease. We buy it at a 7 or 8 cap, and then we hopefully sell it at a 5 or 6 cap, because the 10-year, a 2-year lease versus a 10-year lease, 10-year lease is worth much more than that 2-year lease. And so we're buying things in good locations. Your favorite topic, placer. So we have a lot of, and we're very data driven. So we're looking at businesses that have high traffic counts, or in the top percentile of their actual business segments. So if we have look at a brand, we could look at Dollar Generals in South Carolina. And then when we look at the Dollar General, we know that Dollar General, as far as foot traffic, falls in the top 80th percentile of all other Dollar Generals in South Carolina.
I mean, this is pretty cool software. We put it in a lot of the deal pitches that we have, but it allows us to see basically minute by minute foot traffic at any data point or geographic location throughout the country. And we can use that and say, we want to pick a specific address. We can draw a geofence around that address location. It'll tell us every person that comes into that geofence, how long they stayed there. And also tell them where they went. So we can see where they came from, how long they stayed, and where they're going. And then we can compare that to any other location that we want. We could create a specific geofence location, or we can say, hey, we want to compare this to every Dollar General in South Carolina or every Dollar General in the country. The reason we do this is when you're underwriting a business, we're looking at a piece of real estate that has a business on it. We want to make sure that business is performing well. We can't just go ask all of them. They're not going to tell us.
Or they'll may not tell you the truth.
Right. They're going to, yeah. And imagine if you go to a business and there's a manager there and you're some random person. They're like, hey, we want to know how you're doing. They're going to be like, wait a minute here.
Yeah. Wait a minute. Why are you asking?
Why are you
My
asking?
business is doing great. Why are you asking? Because they're scared because somebody's coming in.
Yeah. It's a weird situation to be in if you're the manager there. But if we look at foot traffic, kind of assessing that, look, if there's more foot traffic, that restaurant or that location is going to be doing better. And therefore we can see the foot traffic numbers, who came, how long did they stay, and compare that across all locations for a brand. And then we're able to see and make sure we are buying brands that have the most amount of people visiting that location.
Right. And so to lead into our conversation before, when we buy a 1 or 2 year lease, we're not buying that lease blind, just assuming they're going to renew their lease. If we're buying a 2 year lease, we want to make sure that business is falling in this top percentile of foot traffic and hopefully sales too, if we get sales data. So our risk then for renewal of that lease becomes very small.
Yeah. Just like the IHOP that we did in Texas, where we purchased it, we had our foot traffic data. We talked to the operator while we're under contract, and we got the lease extension signed prior to basically the day of closing.
Yeah.
That we knew was going to happen. So that's a very good situation where we have not necessarily more, but we have better information in real time than other people that are going after some deals. So we think we're able to capitalize on those and really see the value gains.
And a great example, our Applebee's Seneca property. We knew it was a good Applebee's, a top performing Applebee's. It was roughly just over $3 million a year in sales. And this is one of our leases that releases sales. So we know what they are. And as far as foot traffic, we knew that from Placer. And we also knew that in Placer, it was in the top percentile of restaurants in that area. And so we knew it was a good risk. And right now we're in conversations, hopefully see if it works out to get a lease extension on that. But we do know right now that the latest sales figure they're making, their 2022 is $3.8 million, which puts their rent to sales ratio well below the 8% we target.
And the restaurants, we look at how they're priced. You mentioned 8% rent to sales. So we're kind of a healthy spot that restaurants are in is if they're paying 8% of their sales in rent. One of the benefits that inflation has had lately is, like you mentioned this store, they're going from 3 million in sales to 3.8 million in sales. That's quite a big jump.
Yes, their rent becomes less of a problem for them as inflation goes up. And honestly,
the deal is it's better to underwrite. We're looking at risk of, are they able to make payments? We don't want rent to be too high.
We want their problem to be other problems, not rent. If rent is their problem, that's a problem for us. Yeah. If cost of goods is a problem, then, they have to kind of work out that problem themselves.
Right. But that's been good revenue growth on a lot of the restaurants that we've seen out there. See if we have I don't think we have any other questions coming through on the retail side. So we'll move on to
talking about the Placer data a little bit more as we kind of transition from retail to commercial. We also use the Placer data to look at our office buildings. And, when work from home was much more prevalent, call it 2-3 years ago, and people weren't using their offices at all. These were buildings that we had identified that maybe they had a 3, 4, 5, 10-year lease, but nobody was using these buildings. And that was definitely a concern of ours that we didn't want to go after those buildings. And then fast forward 3-4 years later, and now we're looking at really the recovery of work from home, specifically in the suburban office buildings. And we've seen really almost complete recovery in the suburban office compared to a downtown high rise.
Yeah, I think the foot traffic, when we look at that, it's not only telling us what it is now, but this is historical data that's going back to a 4-year period. So we can see not only pre-COVID, we can see during COVID, and we can see after it to see has this property fully recovered or not. And we've been watching a lot of the, more out of interest, a lot of the urban office just to see what that recovery is. It's been better in Atlanta than a lot of markets. I mean, that's been super in the news. If anyone's been watching anything on the urban office and the challenges that they've had, but we saw a pretty quick return in the suburban office where utilization, mainly from number of people that are coming to the location, returning within that 12-month period of the first quarter of 2020. So that means the first quarter of 2021 was pretty much back to normal. And now we're seeing that our suburban office and really commercial locations, there's people there, at least the stuff that we're buying. We're trying to target that and use that to be able to buy it. So that stuff we have seen good foot traffic on across the board.
And I think our operating results that we'll talk about here in a second are, show that as well, that leasing traffic is high, renewal rate is high, and occupancy is trending higher every quarter.
Yeah. So if we think about occupancy overall, and we had this in our quarterly report, but we added occupancy in all of our commercial asset types really for 3 quarters in a row now, where we've been adding office occupancy, we've been adding occupancy to flex and medical. So it's all been good. The first quarter of 2023 was the first time all of the leases we did have that left were medical. They weren't office, they weren't flex, they were medical tenants. And it was basically 2 physicians' offices that basically just rolled up their doors and stopped. So let's go through, we had a good amount of questions that came in, and we'll tackle some of the bigger ones first, or I would say the more challenging ones. And one of those is the TVTC deal, which is up in Chattanooga. We have owned this deal for quite a few years now, and it has a state of Tennessee in it. I don't think anyone has any real questions on that one. But when we look at the state of Tennessee, a big portion of their lease is our CAM reimbursements and how we're charging back costs associated with operating a building, and that tenant is covering those costs on an annual basis. A lot of these leases are written very differently, so there's only specific points and times that we can true up those costs. Typically, it's once per year where we can go back and say, hey, over the past 12 months, we've paid X, real cost was Y, and we net those amounts out. And there's all sorts of different increases too of what percentages can be increased. Sometimes there's a maximum allowable increase, or there's just set minimums that they'll pay. So each CAM reimbursement is different. So at TVTC, we have a big true up going on with the state of Tennessee to go through our expenses there with them. That's something it's not that we just send them an invoice and they automatically pay everything. Their side of the lease contracting side is very much reviewing our financials as well and involved in that process. So the other big part is MTL Holdings. They have 40,000 square feet at TVTC. So they're very large tenant. They're our largest office tenant by far. Probably 15% of our office portfolio is one tenant, and they are operating 4 different businesses out of this space with multiple leases that we've spent the past 2 years trying to consolidate their lease and get all their terminations lined up. So because of that, we haven't made a distribution here in a while, which I know becomes a concern, and people want to know what's going on. When is this going to come to a conclusion? And we believe hopefully in the second quarter here, that's when all of their leases are set to expire. And at that point, we're trying to get them into one consolidated lease. They're also in the middle of that trying to work a deal with one of their business units. So that's why it's been slower. They're paying 125% rent right now, and they have been for each of their short-term renewals. So we're getting higher revenue out of them, but we would much prefer the longer-term stable lease.
Yeah. So if you look at the balance sheet of TBTC, we have roughly about $800,000 of cash sitting on the balance sheet waiting on this pending lease. And to do the quick math here, 40,000 square feet times $20 a square foot is $800,000. If they were to leave, that's roughly what we would need to retrofit the space, pay leasing commissions, afford some downtime, and release it. So we're sitting on this renewal, and all this cash, just waiting to move forward with them. And it's, the verbal agreements have been positive, and it seems like we're going in the right direction. It's just taking a little bit of time to get through it.
Yeah. And in that time frame, with deferred prefs at almost about $1 million right now. So we have this big chunk of cash that's then saying, what is going to happen with that? And the reality is we don't want to be in a position where we distribute and then have to go back and say, hey, we don't have enough money now to make an effective decision on this asset. That's why we've held in the past and continue to hold until we have that signed. And once we have that signed, we will know really what our full financial position is going to be there and be able to execute on it. So overall, cost-wise, our taxes did go up here. So that's one of the big things we're working on with CAM. Our taxes are about $340,000 a year now. So that's a big discussion point with both tenants as they're pitching in for the CAM costs that are there.
Yeah. And going back to CAM is taxes, it's insurance reimbursement, it's utilities, it's property maintenance. So that can be upwards of 30, 40, sometimes 50% of the revenue of the property and 50% of the costs to that tenant. So it's not just here's the bill, pass. It could be a serious impact on them and on us. So it's a constant evolving discussion.
Yeah. Okay, I'll see if no questions. If there are other questions on TVTC, happy to answer them and go through. I know that's we get a lot on that one of how we're doing and what's going to happen with the lease renewal. So let's go into Duke Medical. This is another one where we have some questions, and this is a deal that we bought. It is up in the Raleigh area. It's called Duke Medical because Duke Medical Clinic is there, but it came with some vacant space. And
yeah, so it's roughly 80% occupied when we bought it, and really the value, we bought it with in-place cash flow to really cover our carry. But really, we would start making distributions, making money once we lease that remaining 20%. And we've been talking to a lot of tenants, talking smaller leases, 1,500 square feet, 3,000 square feet. In the middle of this, what we always go to our existing tenants and offer them really a first right of refusal. Some of the leases require it.
Yeah, these leases required us to, if we have a lease, have to bring it up.
Yeah. So, and one of the medical tenants, when we went to them with the first right of refusal, they came back saying, "Hey, we like this space." So we kind of put the brakes on new leasing, and we're going to start discussions with them to take over the remaining space. That would be a huge win for the property.
Yeah. So we have a lease in hand there, and essentially the existing tenant said, "No, we would like to look at that space first." So now we've got one lease in hand where we're trying to, it's like, wait, what was going to happen here? And our existing tenants, so they have 30 days that the first right of refusal is in there to fully either say yes or say no. Right? They have to make a decision. They can't just drag it on forever. But that would be highly positive if they take the remainder of that space. That's what we're looking at right now. But also in the middle of that, if you recall, when we did buy this one, we purchased an HVAC system, which is $100,000. So it's a very large system. And they gave us a lead time of over 30 weeks. And we still do not have that system in hand yet or ready to be installed. So that is something that it's taking a while. I mean, we knew it was going to be 30 weeks when we first ordered it, but it's still not here yet. We're coming up. That 30 weeks is coming into the second quarter here. So we're hopeful that is manufactured and delivered soon so we can have that space with heating and cooling. The vacant space right now does not have an HVAC system in it. So this is the system that has to go in there before you can even get a CO or have anyone in the space. Once we do that, we'll then know our total cost, and we will be in a position to start making distributions once we have that in there. Because we have the funds on the side, and we have a bank draw capacity there. We've worked with our lender. They know that this is coming. They know we haven't put the HVAC in yet. They know that we're negotiating leases. So we have bank draw capacity left there that we extended our draw period so that we could facilitate completing this lease agreement.
Dave, just brainstorming here, but why don't we just go to Home Depot and go get some of those window units and put it in that building for a little bit until we get the
swamp
big one?
coolers, just get the 5-gallon
Yeah,
buckets.
can we do that maybe? Or
I don't know how many we would need, but it would be a lot.
okay, 5 or 10 maybe.
It has temperature control in there. So the standpoint of like, it's not 100 degrees and 30 degrees, but not
Right, so
functional.
maybe not a good idea. Is that what you're saying?
Not great
maybe
for
not.
lab space.
Just
Yeah,
trying to,
not great for
trying to
lab
think out of
space.
the box for you right here. Yeah.
So, but we are hopeful that in the second quarter, I mean, I know that's a similar story to TVTC, and it's like, hey, why does this stuff take so long? But a lot of these commercial leases, and a lot of this larger equipment, it is not a game of speed on some of their parts. So we're working on that, and we're hopeful that in the second quarter, we'll have the HVAC installed. And we know for a fact that within the next about 15 days here, we'll have an answer on our lease with either the one we have in hand or the current tenant taking that over.
With the swamp cooler provision. in
With the
lease-
swamp cooler
in the
provision.
amendment. Yes, yes.
All right, so next one, we also got questions on is Johnson Square. And this is a deal. One of our first office buildings we bought, it was at 68% occupancy when we were going under contract on it. And we've been signing leases and gaining occupancy there. We're up to 92% occupancy here. It's been a very good run of gaining tenants here. One of the other parts of this, though, is we did not make a distribution, and we have over 60 tenants that are at this location. When we first put together our reserve strategy, and I think we go back to our reserve strategy, this was put in place to be very conservative in 2020, right? That's when we're like, look, we want to make sure we have cash. And our reserve strategy has been to put in $2.25 a square foot on every asset, and we reserve that for the year. At the end of the year, we assess, hey, if we spent it, then okay. I mean, it was there to be spent, and we'll restart the reserve number. So if our goal is to get to $100,000 for the year, and we finish the year and we have $50,000 left, like, okay, well, next year we'll start with 50, we'll reserve another 100,000, we'll get to 150,000. And that's been our strategy going forwards. The deals we have with so many tenants, we're not actually hitting our reserve numbers. We are spending that money continually as we have new tenants, as we have turnover, as we have leasing commissions, as we're doing improvements. So Johnson Square, we haven't really been adding to our reserves. That's why our controllable expenses look so much higher. We've been spending those and actively turning and gaining occupancy since the day we purchased it. As we're able to extend our weighted average lease term, right now, if we're in the 2s, we need to get to like the 4+ range where we have some kind of calm in the turnover. But we're not seeing businesses signing 4 and 5 year leases when they have 1,000 square feet. All are smaller tenants that'll sign a 1 or 2 year lease. Anything else you want to add in Johnson Square?
I mean, overall, we're excited that with the property being 92% occupied, this is probably one of our most generic office properties with the 60 or so tenants, and it's well occupied. We have fixed debt at 3.5%. It's phenomenal. And we think we're in a good position to hold for this.
And overall, we still have about $400,000 of loan capacity left. So we could draw up the remaining CapEx that we have spent. We have completed all of our work that we had planned to do there. So we can draw up that remaining $400,000, which we'd be doing at the 3.5% fixed rate. So we're working on doing that in the second quarter. And then we'll be above our reserve goal at that point with those funds drawn up, but also just planning for what other added occupancy we can do there, who we can move in. Seeing if we got any questions. All right, let's do 1824. We had questions on this one. So these are our VA deals. We bought 5 VA clinics, and we haven't really bought any in the past year or so. They've kind of gotten too expensive for us to buy. So we got priced out, but we finally got our lease extension.
Yeah. So this one was a kind of a rolling 1 year lease for 2-3 years now. And we bought it with kind of the tail end of a 1 year lease, and then they signed another one and another one. And so the success is we got a 3 year lease out of them, which is tremendous compared to our 1 year lease. Which enabled us to get an extended loan as well, because we had a loan that was also renewing on an annual basis.
That was one of our shortest loans. We essentially had, it's not loans that we like doing. I mean, we do not like short-term loans, and we do not like floating rate debt. And in the 1824 Hillendale loan was essentially tied directly to the lease, since it's a single tenant, and they were only extending it based on lease terms. So we were basically at risk all the time of is this loan due? Are they going to renew it? What's the situation? And now, out of a 1-year lease, we now have a 3-year loan, but it is just tied directly to whether they're paying the lease or not. That's it. But GSA wasn't necessarily looking to do a 10-year lease. And for the most part, government leases too, if they went out after a year, which I think is probably a good thing. If you're thinking about from our government standpoint, if they went out of a lease at the end of a year, they're allowed to get out on any GSA lease that they have for the most part. Anything that we have at least too. So, but they have 3 years. It has 3% rental rate escalation. So we see that as a good thing. And we're good for another 3 years on this point now. Okay. Yes, we will talk about Midtown Office Park. So on that question, we can go into that one now and go through it. So Midtown, if there's no other stuff on 1824, but on Midtown, so we're coming up on a year on Midtown, and we have a huge amount of capital improvements that we have been doing there in that 1-year period. The biggest part of that was the City of Chattanooga lease space. That was like 25,000 square feet, 27,000 square feet that they moved into. We're just going through our final draws on that. That was around $1 million of capital improvements that were done on that space for the City of Chattanooga. They're in, but we're not done with all we're finalizing the change requests and the final draws associated with that construction project. So that was very large. That is by far the largest tenant improvement project we have done. We didn't perform that though. I mean, we had a general contractor that did all of that work, and that was in the works with the City of Chattanooga well before we were involved with the asset. So we kind of just saw the final completion of it. And going into Midtown, our plan all along there was to stabilize how the deal is performing, actually get CAM out to these tenants. So the previous owners had not been charging CAM. So
it's a huge chunk of revenue.
I think our overall CAM numbers or overall expense numbers associated with CAM are around 1.2 million that have to go back all the way through 2022. And then this is an individual discussion, which with every tenant, as we add those charges to their 2022 true ups and then monthly going forwards in 2023. So there's a lot of work to do on that front. And if you look at our Midtown actuals versus pro forma, that's how you see our revenue is below. It's not necessarily revenue that's below. Our rent per square foot is on. It's our CAM per square foot that we have significant adjustments that we're making to.
Yeah. So really two big things that are really driving our cash flow or really our balance sheet, our cash balances is one being constant improvements on the property that we're spending money, we're writing checks, and then we're going to the bank saying, hey, can you reimburse us to rebuild our balance sheet? So that's the primary one. The secondary one is we have to wait for the cycle of CAM to be really complete. In that first year, it's receiving all those monthly bills, that first tax bill, first insurance bill that are annual, and then billing all those back and then receiving all that money. That's a 3 to 6 month minimum process once you have all the bills. And we've been really just on the tail end of getting all the bills. So in our first year, annual cycle of this property, that's what we're living through right now.
The other part that we had on this deal was we have one standalone single tenant medical building, and we are looking at, we talked with Andrew, was talking about the prices of the net lease assets or the triple net or retail that we're talking about. The medical ones have still been very expensive, even with rising interest rates. There has not been a huge adjustment in cap rate on a lot of those retail assets.
Right.
So we're looking at selling one of the retail assets we have in the Midtown complex because it is a standalone medical asset that we'll be able to realize a pretty healthy gain on. Overall, we're about $80 a square foot is what we're buying.
Yep.
And we've purchased medical up into the 160s, 170 a square foot. And once it gets more than that, that's kind of too expensive for us to be buying. So we're thinking we have a pretty good exit opportunity with this one tenant, and we're coming up on a year. We did want to hold that for a year, so we're not faced with short-term capital gains on an exit. So we'll be working on that portion of the deal as we come up in the second quarter here, if we can realize some gains on that. And that's been our strategy from day one. on Midtown. See what other ones we've got in our queue here of questions. Dawson. This is the next one here. So we had some questions on when we are going to project to make distributions at Dawson Flex. And we're at about 8 months of owning this now.
Give or take, yeah.
Well, I think it comes up at the end of the second quarter where we'll be fully at a year. But we bought this deal with 30% occupancy. This was the largest vacancy of any asset we had ever purchased.
Mhm.
So we've got about 55,000 square feet that was vacant when we purchased this deal. And it's in 2 separate buildings that we feel confident we can get something signed on. So we signed post first quarter, we've signed 1 lease for 12,000 square feet that is here, and they move in. I mean, they move in relatively quickly. They move in on Monday.
Oh, wow. Yeah, that's great.
So they move in May 1st, which was very fast. But because of that, when we were negotiating the lease, we're always wondering on TI and stuff, and they were like, don't do anything, let us just have it faster and we'll handle that part. So we're coming under on our CapEx plans by a couple $100,000 here. Dawson, I mean, this is a big spend. We had $2.7 million in capital spend allocated to the Dawson deal. And that's everything. I mean, across 55,000 square feet, we've got parking lot work that we're doing, entrance curbing that we're doing, fire rated walls, sprinkler systems, access doors. So we got a lot of work that we're doing. A lot of that is also tied to leasing commissions that we expected to pay on 55,000 square feet. And we have this first lease for 12,000, and we're in about our 3rd or 4th round of negotiation on a 40,000 square foot lease to take up the remainder of the, what I guess is building 2. Not sure what the building number is. You don't know off the top of your head, do you?
Yeah.
So it's 3 buildings, but we've got 2 big tenant suites that right now, one's leased and the other one is scheduled for an August 1st move-in. And we would have certainly a bunch of construction. We still have to rapidly finish up by August 1st so that they can move in and take that space. So we're working on that with them. That lease isn't final, but I feel pretty good. We're on our 3rd or 4th round of going back and forth with our attorneys on getting that solidified. We've met with the owner, family-owned business that's international footprint. So it's an impressive organization. So we'd be happy to have them as one of our tenants and work with them for a long term. So we're working on those 2 things. And once we have those in, that's a little behind schedule. We were hoping that we would be full and paying rent in the second quarter, but they're not going to move in until August, and they won't fully pay rent for about 3 months after that. We're going through the abatement period. So a little behind on what that total rent payment will be, but we feel good going forwards that we'll be in a position to make continued distributions there long term.
Yeah, and really the big news by the initial plan was to take, say, a 40,000 square foot box and break it down into 2,000 to 5,000 square foot bays and spend quite a bit of money on making entrances, putting demising walls, putting roll up doors on the back. And by signing 1 lease for the whole 40,000 square feet to 1 tenant, we're going to avoid really all that extra spend. So that we have roughly 1 point of the 2.7, 1.7 is designed for tenant improvements, and we should save several $100,000, maybe north of $500,000 on that build out, which is going to lower our basis significantly.
Yeah, with that extra cash, we've got a mix of all of these big construction projects have a mix of debt and equity. And we don't know what the exact answer on that is going to be, but we're going to look to minimize our debt cost. And if we have excess capital that can return, maximize how we can pay that back if we're not going to deploy it. So what we wouldn't do is leverage up everything.
Right.
It's like we're going to use the most effective cost of capital that we can on the loan here. So, yeah. Any other questions? Let me see. No, we didn't really have any other questions on deals prior to going through this stuff. Clarifying that so everyone could hear what it was, but one is on the retail funds. Are we looking at other states and what does our footprint look like? We did go to Texas. Are we looking to do other locations? And then what other brands are we looking to work with going forwards?
So it's really 2 questions. It's states and brands. And so the 3 of us many months ago did a whole analysis of the entire US. And of course we try to be data driven. And so we literally look at all the top markets in each of the states. And then some of the top markets in the states, it's not necessarily a state, it's one city in the state. What was the example of that one?
Like a Boise.
Well, yeah. So literally, so some states literally have one market in the state. And so we took a whole analysis and figured out, okay, where are people buying? Where's population growth? Where's economic growth? And we did an analysis of looking at, okay, so which market should we be in? And so if anyone's ever interested, I could actually take you through the analysis we did, but we resolved that we have about 10, or is it eight states? We resolved that we want to be in North Carolina, South Carolina, Tennessee, Florida. We're in Kentucky by default. So we just added Kentucky to the list. Texas. I think we did put Virginia on the list. Northeast is all mediocre as far as economic growth right now. So there's no real Northeast, and then there was, did we put Arizona on the list?
Probably Arizona,
Yeah,
maybe
Arizona.
Colorado.
I think
But you look at some of those cities that have population growth over the past like 3 years, kind of like the COVID boom towns of
The work from home boom towns.
the work
Yeah.
from home, but like you're working from home and you're hiking.
Yeah.
I don't know.
working
That
from home and hiking
population
is
growth
good.
isn't necessarily,
Yeah.
so that's a lot of that was like Boise, Idaho, had a huge population growth post COVID, but as those, you know, I don't know if that's sustainable. So we're not really looking to invest in those types of cities. We need to have population growth that's actually driven by
Population growth and economic growth, which usually
economic growth. Yeah.
comes hand in hand. But we are in Texas, so, and we did 2 deals in Texas last year.
Yep.
And so that was a new market for us. And then also for brands is a very interesting conversation because a lot of mature brands like a Zaxby's or a McDonald's or a DQ Grill and Chill, or even like a Burger King, Chick-fil-A, your favorite Chick-fil-A. These brands are mature in the market. They're going through growth, and quite frankly, they're just too expensive for us because they're good performers. They have every year their balance sheet and their economics get better. And so McDonald's right now, or Chick-fil-A, we kind of laugh at it. We've seen Chick-fil-A trade at a 3 cap. And so
Yeah, even in this current market, trading at
yeah. So, what would
Crazy.
possess someone to buy a deal that's going to earn you 3.5 or 4%?
arguably lower than a treasury bill.
Yeah. Yeah. So when you could just
So-
go right now, at least you can go down the street and go get a money market account or a CD for 4.5% right now.
Yeah.
So those brands are a little bit too expensive for us. But what we are looking for is we're looking for the emerging brands. So I could say that maybe Zaxby's pre-Goldman Sachs merger was an emerging brand. And so we developed a Zaxby's partnership, bought these, and then all of a sudden, out of nowhere, Goldman Sachs comes and buys Zaxby's. And so Zaxby's became another premium brand. And so right in our portfolio, we had a brand that was growing into a brand that was going to go to a whole new level with Goldman Sachs. And so we're focusing on those brands right now. So what's the 50-unit brand that's up and coming that isn't priced yet like it's an up and coming brand, or isn't priced like it's a McDonald's or a Chick-fil-A? And so really it's the same thing with states. We're looking at brands that we don't feel their value has been achieved yet.
So what are some of those examples like that maybe we know as we drive around the Atlanta market?
Well, like I will say one brand is like a chicken salad
salad chick.
chicken salad chick, but you know what? They've already
Yeah,
They've
they
been priced
blew
up.
up.
they've
Yeah.
already been priced up.
One of the other ones you looked at here was Lazy Dog. That's a big restaurant that's here. Not big number of units. It's physically a very big
It's
restaurant.
huge.
Yeah, and the one
So we looked at their build out costs of the brand. It's a great brand. There's one right down the street here we go to frequently, but the footprint is so large that it's kind of outplaced from other
yeah,
restaurants.
like I think one Lazy Dog is probably like 3 Applebee's, 2 or 3
on the
Applebee's.
size wise. Yeah. So
Yeah,
the
yeah.
numbers were a little bit off on that brand. So we didn't go into buying those because you're paying a lot for the physical real estate footprint cost versus that brand cost. And that brand cost is what really can push down a cap rate and increase the value. So we've got to find brands that have a reasonable footprint, that are smaller unit count and able to rapidly expand so that you can see that contraction of cap rate
But
simply from their brand.
if we find a brand that is maybe at 30 units now, but has a real plan to grow to 60 units in 3 years, I mean, those are the brands we want to focus on right now.
Another question? Yeah. With what?
Grapes and grain.
Oh, with the
Grapes-
antique
grapes and
building,
grains.
which is Grapes and Grain. So when we purchased Antique, we were going for an office conversion, and we ended up
It was going to be the Greenleaf office, I thought.
with very high-end wine liquor distribution center. So that complex, I mean, they're in there, they're paying rent, but we have had a 3-year battle with trying to get the sewer connected at this property. And we finally finished that project. It took us forever to just get approvals, and the tenant is paying and it's covering our costs. And in about 4 years, they have incremental rent increases between now, and they've got another one in about 10 months, and they have another one at 2 years and another one at 4 years. So it ramps up pretty quickly here. And at that point, we'll be earning about 14% cash on cash on that deal. Starting from now, we're just kind of break even as they're in there. But if we have an opportunity to realize that value sooner, we're going to take whichever. We're really going to look at it from just which scenario provides the best present value on a deal. And we look at that from, are we going to capture value in the apartment space, or is there a way we can take a retail deal that gets a lease extension and realize that value and turn it into current equity? We would do the same thing there. We're not actively listing it for sale or anything like that. But it is one we're looking at because we do have an exceptionally long lease there. Overall, we have 18, I think we have 18 more years left on that lease there. Across any asset class. Question came in here. Do we have any new deals coming up for 2023 across any asset class?
Oh boy, that's a question. Isn't it?
Well, we just closed 3 in this past month.
That was the best start to, I think, any year we ever had. So great beginning.
Yes.
Yeah.
Yes. I guess they're asking going forward. So.
Yeah, so going forward, so one thing we've looked at is we've looked at a lot of vacant warehouse buildings that we own other warehouse buildings around them that we've leased up already and have proven the model for. And so we went out to the market and basically said that there's no lenders really out there right now. The small lenders for these mom and pop warehouses have just
for vacant space.
for vacant space.
Hard. That's hard to find debt on right now.
So we've asked them to basically do seller's financing, and we had one come together. It's a smaller property. We're underwriting right now. It's very likely to be our next deal. But the challenge is really finding the right property and the right seller to kind of marry those two things together on these warehouse deals. The cash flowing deals, and Andrew can probably echo this.
Cash flow, government leases also. Government leases very much like retail, where
or a fully occupied warehouse, and
right.
anything
that's going to just pay a normal dividend. When you have debt at 300 basis points higher than we were last year, it just doesn't cash flow anymore. So these cash flow deals are harder and harder. So I think really what we're focusing on fixing things, fixing a vacant building, fixing a lease, fixing low rents. And so the old fashioned buy a triple net lease and get a 8% reliable cash on cash return on has kind of disappeared for a while. So we're looking at different types of assets. And apartments, I'm assuming apartment deals are the adjustments have not happened yet.
They're so expensive, and we're selling. We mentioned one deal we're under contract with on
Yeah.
apartments to sell. We're selling at rates we wouldn't buy at.
correct.
Yeah. And remember, I'm an apartment guy.
10 years of doing it. But
Yeah, but over
Right.
10 years. Yeah.
right now, sellers haven't adjusted their demands, I would say, on pricing compared to how fast mortgage or debt rates have changed. So if debt rates have gone from 3% to 6%, well, cap rates really haven't changed that much because sellers are basically holding firm and saying, no, we want our money.
So everything we're focusing on is some form of value add.
Yeah.
The long-term hold cash flow deals are not necessarily what we're buying right now.
So that's kind of a longer answer to your question, but in the short answer is right now we do not have anything under contract. So the longer answer, what we went through there is we're confident we're always going to find something, and we're always out there looking and trying to dig things up. But as of today, we don't have anything under contract, which means typically that we won't see anything kind of closing in the next 60 days. That's about how far out we're looking at any given time. That could all change next week, but
Next
That's
week,
where we're at
we have
right
10
now.
deals under contract. And
yeah, I don't see any other questions coming through here. We'll keep it open for another couple minutes, but those are all the points that we wanted to go through today. So if you do have other questions, we'll leave it open for a tiny bit here. And thanks for watching here and listening to us go through all the deals that we've got going on.
And thanks for everyone coming in person as well.
Yeah, we have some people in person.
Yeah.
For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.